Well, we just got the September Case-Shiller home price index, a report out on housing a few moments ago. A bigger drop than expected. Atlanta hard hit. You also had Detroit, San Francisco, Minneapolis, Las Vegas, again being very hard hit in the housing markets. Now, for more, we are joined by Bloomberg Best Chief U.S. economist at RBC Capital Markets, Tom Porcelli. Tom, great to have you back on the program. And, you know, whatever these numbers are month by month, what you're saying, as I recall from the notes, is that basically housing prices are still set to fall, maybe even by 5 to 10%, right?
Yeah, that's exactly right. So we do expect another 5 or 10% decline in home prices, and that, of course, is because of the supply-demand imbalance that's in place right now. I don't think anyone should delude themselves into thinking that housing is near a bottom in terms of prices, particularly with such a pronounced supply issue out there.
And Tom, do these numbers, these Case-Shiller numbers, tell you that perhaps this 5 to 10% drop could be happening sooner rather than later?
No, we still think it'll be sort of a drawn-out process over the course of the next year. But again, clearly today's report is very consistent with the general trend that we do expect.
Could it be deeper than 10%?
It certainly could be. I think one of the things that, and I don't want to scare any of your viewers, but one of the things that we love to do around here is something we call shocking our models. So what we did was we shocked our model with the shadow inventory. And of course, the shadow inventory is just the number of houses that are either in foreclosure or delinquency. If we put in the entirety of the shadow inventory into our home price model, home prices would fall another 30%, 30%. Now, I want to make sure this point is abundantly clear. We don't expect that that'll happen. The shadow inventory would never make its way like a wave into the market. But instead, what I think it does show is where the market clearing price is for homes. So I do think that we still have a long way to go before we see anything resembling normalcy in the home market.
Well, is there anything, and Tom was talking about this with Carl Case, is there anything on the public policy front, anything that the Fed could do, for instance, lowering mortgage rates even more to try to take up that demand or try to stoke that demand for housing?
Yeah, unfortunately, the consumer is very unresponsive to already historically low rates. So, I know QE3, if that does come about, I think the Fed will wind up focusing on MBS securities. Again, in theory, this is sort of a great idea. I appreciate that stance. But when you have a consumer that's largely unresponsive to already low rates, I don't really think it's going to make much of a dent. So I think that's sort of a long way of saying policy really can't help the issue out.
So then what will? I mean, what will likely spur that demand from consumers?
No, it's nothing that you could do to spur demand. I'll give you the one response that everyone hates. It's a question of time, right? I mean, that's the solution. I think we just have to wait for this supply-demand imbalance to literally work its way out, and that's a multi-year process. And fortunately, we are a couple of years already into this multi-year process. So, over the course of the next couple of years, we would expect some stabilization in home prices and in the home market in general. But there's nothing you could do to force that along.
But Tom, then let's get your forecast. Then I mean, you say a few years out. What are we talking about? When is your prediction? What year or years will we start to see a bottom in the housing market? So
I think there's two ways of thinking about this. One is from a price perspective. From a price perspective, over the course of the next year to 2 years, you're looking at probably finally some real stabilization in home prices before they finally start to rise in a much more modest way. But again, that's at least a couple of years out. From a sales perspective. And actually more specifically from a construction perspective, right? From a GDP impact perspective, even next year you'll see some stabilization from an output perspective on homes.
Right, because I was looking at Toll Brothers, which recently came out with their earnings, right? That's the largest U.S. home builder, and they said that they're actually seeing in the fourth quarter, they saw an increase of 24% in orders for homes. So, we saw home prices or new home sales yesterday rise. So why are we getting, sort of these new homes and this demand for new homes when, in your view, housing prices need to fall even further and the demand there is slack right now?
Yeah, so there are a couple of ways of approaching this. One, I think you have to take all of these numbers in stride. It's true that new home sales rose the other day. They rose by, I think, almost 2%. But they rose, very moderate. They still remain within a range that they've been in for the last year. So, all you're doing is you're seeing volatility, you're seeing wiggles off the bottom. And I think that's an important point. So that'll probably continue to be the process. But from a price perspective, you have to remember that there's still this oversupply, and that will ultimately weigh on prices.
Tom, thank you. Really appreciate it. Tom Porcelli from RBC Capital Markets.